Marty Cicco, managing partner with MJC Associates, has an extensive career in real estate investment banking and principal financing. Marty, I'd like to start, if you could describe the current environment for real estate acquisitions.
Well, I think things are getting closer to starting to transact, but obviously there's still a lack of transactions actually closing. I think a number of factors have held the market up, not the least of which is anyone really determining where value is. But candidly, the gap between bidders and sellers is still pretty significant, and we're starting to see that gap get a little bit closer, but still hasn't resulted in a lot of activity.
Now, do you have a timetable for when you expect that to shrink?
Candidly, the whole financial institution has the popular term is kicking the can down the road, but a lot of the institutions really haven't acted on foreclosing on the properties. That activity's picked up particularly in the hotel sector, predominantly because those cash flows are below where the interest coverage is, and a number of the hotel properties are not even covering operating expenses. And candidly, I think as long as the loan can be covered by the debt service can be covered, the lending institution is giving extensions, forbearance. Even in the CMBS world, you've seen a number of the extensions go on. But the rally in the public market over the last 6 months and where the valuation is of some of the public companies keeps our optimism relatively high, but you still have a lot to work through the system. But we would think by mid-year you're going to start to see actual properties start to transact.
And in 2010 and maybe into 2011, do you expect most of these deals to be kind of individual assets, or are you thinking more portfolios or whole companies?
We believe, though, it will start with individual properties. And that's the form that I think it'll take. How long, from a corporate M&A standpoint, in the REIT world at least, one thing that the disruption of the last 2.5 years has caused that candidly did not exist all through my 30 years or so in the business has been that the public market is actually the companies are starting to trade at pretty significant multiple differentiations. For the large part, I think the market has to get some feet on the ground with individual assets. There's still a lot of equity that needs to be raised to lower the leverage of a very, very over-leveraged asset class, which real estate clearly is.
For REIT.com, I'm Matt Bishar.